Welcome back, everyone. Michael here with Offshore Citizen. We're going to today talk about the subject of why you should consider real estate, the pros and cons of it, and where it's like how it fits into your portfolio as some place to put money. And I bring this up because of the fact that I have certain clients who they're kind of like, hey, listen, I'm not really so sure about real estate, etc. Obviously, there's again pros and cons, but I wanted to cover some of the advantages intrinsic to real estate that are not in some other situations or in some other assets. And this will be part of kind of an ongoing series. I'm going to do some stuff on investing and different types of assets, and I'll look at how it applies to you from an international standpoint versus a domestic standpoint, and so on and so forth. But yeah, we will go from there. So if you have not done so already, please click the subscribe button, click the notification bell. If you like the video, give it a thumbs up, click the like button. If you don't, please tell us in the comments. Really appreciate any feedback you have, etc. And if you're interested in international tax planning, how to structure your investments, structure your assets, how to reduce your taxes to the lowest legally possible, how to form offshore companies, or would like help forming offshore companies, open banking accounts, or getting residencies, citizenships, etc., please reach out to me, cardio.fm/Michael Rosmer, there's a link below, or check out our websites, offshorecitizen.net, offshorecapitalist.com. Okay, now diving into this subject. As I said, there are a bunch of people that I know, a bunch of clients who say are sitting on a bunch of cash. Good for them, that's fantastic. And really, you don't want to sit on a bunch of cash unless you specifically have some opportunities there that you're looking for a few different reasons. I mean, first of all, over time, cash is going down. Now, of course, you know, at any given period of time, assets could drop relative to cash, but by and large, averaged out over time, it's better off to have your investments there. And I'll give you a really simple example. If you were to make $60,000 a year every year for, hang on, yeah, do I have these numbers right? Yeah, $60,000 a year every year for 30 years, and you saved it all, right? At the end of 30 years, you'd have $1.8 million. If you were to invest that money, so each year you're putting that in, and you were to invest it at 20% a year, now 20% a year is aggressive for most people, but let's just say that you could do that, then you would have like $99 million, okay? So the difference between 1.8 and 99 is a really big difference. If you had, I think it was 10%, 10 or something, I think it's 10%, you would end up with like 12 million, something like that. So it's a really big difference, okay? Like, I think a lot of the people that I deal with, they're good at making money, they have successful businesses, they produce cash flow, but then they're not necessarily good with what to do with it from there. And it's fair, I think, to suggest that, hey, listen, I take risk in my business, I've made the money, I don't want to take risk with it and possibly lose what I've had to risk to get there, right? So I take risk in the business, I'm going to put some money into something safe. Fair enough. When you start looking at that, then the question becomes, well, where are you going to allocate that capital, right? And of course, you can do things like buying an index of the S&P 500. You could do some sort of bonds, although most bonds are terrible today. Some people are like, hey, I'm going to go and look for the high interest savings in Egypt. I think that's a bad idea. What I usually tell people, like I have people who come to me and they're like, hey, like, what do you think about the high interest rates in this country? I'm like, you know, realistically, your money is safer going into solid real estate that produces you good cash flow. You can get those types of returns off the real estate, and at least you know you own the asset, okay? So yeah, there's a liquidity thing. So, you know, if you are gonna need the money in a year, then that's not so great. But otherwise, I think it's a much safer place to put it. And so let's talk about how some of this plays out. So first of all, real estate is an asset that typically is not globally exposed. What do I mean by that? If you buy a property in Montenegro or Turkey or something like that, that's typically not reported back in your home country. It's not subject to the same awareness in terms of, like, you know, it's not part of FATCA, it's not part of CRS, it's not part of a lot of this. So those are assets that you can have sitting somewhere that are pretty unexposed, right? So that's a good thing. Second of all, real estate is like, it's literally solid. It's literally there. Okay, so the likelihood that you will lose a dramatic amount of money on real estate, and I'm going to get into some of the details about, you know, what would determine that, are fairly low. Okay, so you basically can't go to zero without leverage. Basically, I'll go into some of that. Yes, there are some risks of natural disaster, of fire, of things like this. You can usually buy insurance for that, so that's more or less good. You may realistically, you know, to claim the insurance can be a hassle, so you're going to consume some time and things like this. That would be a bad scenario. I know somebody recently who had one of his commercial buildings burned down. Not good, right? It's a pain, but ultimately, it's not like his investment went to zero. The insurance company paid him out $1 million or whatever the heck it was, and so good, right? Fair enough. So why real estate as compared to say stocks, right? Obviously, if you're talking about stocks, they're very liquid, right? Meaning that I can sell them tomorrow. I can't do that with real estate. So I'm trading liquidity. And same thing if I'm talking about any sort of a private business, right? Say I'm investing in some sort of venture capital, VC type stuff, angel investment type stuff. I'm buying some business. It's illiquid, right? So my ability to just sell it is not great, right? Certainly not great. Now, you can get that money out definitely much more easily out of real estate than you can out of most businesses. Because in a lot of markets, if you're willing to lower your price a little bit below market rate, there's always buyers for real estate out there and somebody will swoop it up. The question is just how much you have to drop it for. And on top of that, you can often collateralize it. So basically we can go and borrow. Now, that's a little bit trickier when you're talking about a foreign country, and I'll do another video on that about the consequences of real estate in foreign countries versus when you buy locally. But anyway, the main things about real estate that are quite unique, that are quite important, that give real estate some major advantages, there's 3 of them. One of these in particular will typically not affect you if you're doing it internationally, or not affect you as much. It could affect you somewhat. So let's talk about that one first, which is creative financing. So you can buy real estate in theory with no money, right? Now usually you're going to buy it with some, but you can leverage it up to some extent. Now, note of caution, the one way that people will primarily lose money on real estate is due to leverage, okay? So certainly you can magnify your returns with leverage quite dramatically. You can also magnify your losses quite dramatically. I was talking to somebody when I was in Paris recently, and we were just discussing, I was saying how insane the prices were, and they were telling me that the environment there is such that your interest rates are super low, like 1% kind of thing, and you can get these hyper leveraged properties like 99% loan to value. So you're in a $6 million property in it for 60 grand. And so if it goes up, 5%, you made a ton, but if it goes down, you're going to walk away from it. So it's basically the bank's risk, right? That's kind of the approach to that market. So that's okay. Like I kind of get it. Generally not my style, right? I'm not into that. I'm not against leverage on real estate. I think that the fact that you can have a tenant pay for it, great. So that's the first thing, is you can potentially acquire assets the ability to get financing in real estate is pretty close to second to none, right? There's a few other places you can do like some really fancy financial engineering, but real estate is very, very well established, in part because the values are considered very solid, the cash flow is considered quite solid, and it's a easily understood asset, okay? So that's number 1. Number 2, and this is like probably one of the most important things, you can buy a property for less than it's worth. So you can't do this with stocks unless you have some sort of a private placement or something like that. So if I go and I buy Apple stock, I'm buying it for whatever it's worth that day, okay? I might think that it's undervalued, right? So I'm like, okay, great. I'm picking it up for whatever, X dollars, and I think it should actually be higher, and so I'm hoping that it's gonna go up, but I can't immediately step into net worth, okay? With real estate, I can go and I could buy a property for 10, 15%, sometimes much more, under market value. And the day that I buy it, my net worth increases. So let's talk about how that works. Let's say you're buying a $500,000 property, okay, just for simple numbers. The property is actually $500,000, but you negotiate to buy it, based on the market conditions and your negotiation and whatever for 400 grand, okay? Well, the day that you buy it, your net worth went up by 100 grand. That's great. That's fantastic. Like you can just step into net worth. That's a pretty rare thing. Like, okay, you could do it in theory in vehicles or something, but the problem is I've bought vehicles for below market value before, and you could get a lemon, and then on top of that, vehicles tend to be depreciating over time, so you have kind of this risk there. Some other assets, it's harder to determine what their value is, etc. There's always an uncertainty for real estate as well, but this is pretty advantageous, the fact that you can buy for less than it's worth. So in my opinion, one of the number 1 rules on real estate is always buy for less than it's worth. Always. Just never buy anything that's not for less than, that's one of mine anyway. Third thing, the ability to force appreciation, okay? So I think about what's the worst that can happen. And a lot of situations, I bought some assets recently, and I was sitting there looking at them, and I'm thinking to myself, like, what the problem with these is? I have no control over what happens. I made my decisions based on my research and my logic and things like this, and maybe I'm right, maybe I'm wrong, who knows? Hopefully I'm right, hopefully things go well, and hopefully I do pretty well at it. But if I'm wrong, there's nothing I can do, right? With real estate, if I'm wrong, if something happens, etc., I can afford appreciation by renovating it. So this is one of the reasons why I don't like buying off plan. I don't like buying a brand new property. I've gone and compared many times brand new properties to pre-existing properties. And the problem is you pay a premium for something being new, but the problem is it won't be new 5 years from now. So why am I paying the new premium? I would rather buy something that already has that wiped out of it, take it, let them, the other person pay the cost, and I can turn around and do whatever. Now, the ideal is that you buy a property that you can go and fix up. And I've mentioned this in some of my videos on Montenegro, talking about the property market there, where I just look at the differential between what you can buy a property that's kind of like an old style versus the new nice ones. And it's a massive differential. So you have quite a margin to put some budget in there, renovate it, and boost the price. And so depending on how good you are at it, right? For every dollar you put in, you can increase the value by, X, some amount higher than that. Now you can waste money, of course, too, but that's the case. So from my standpoint, this is like a really important thing, is when I'm buying, I want to make sure I buy for less than it's worth, and I want to buy a property that if I need to, I can force appreciation on. Okay, that gives me a degree of security. Very, very good. Again, can I do that when I buy stocks? No. Can I do that when I buy bonds? No. Can I buy for less than it's worth? Sometimes you actually can buy bonds for less than they're worth, so that's a little bit of a different thing. But can I, force appreciation? No. Now let's talk about some other things that are nice about real estate. So as I said, it's super stable, right? Not necessarily, in terms of the prices, it's pretty stable. Like, it doesn't tend to move very fast, but it's solid, right? Like, the likelihood that you're going to have a dramatic loss is fairly low. The second thing about it that's really good is you get cash flow. Now, some people buy properties that don't have cash flow. I think you're kind of dumb not to buy properties with cash flow. I'm all about positive cash flow properties, okay? So that's an advantage. So great, what does that do? If it's paying you every month, and if you made a mistake on the price, then by holding it, basically the rent pays for that, which is fantastic, right? It's often tax advantaged. That's very good. It's deferred. That's also very good. We like all these things about real estate. One of the big problems with real estate is the transaction costs are very high. So to me, trying to do rapid transactions is not where it's at. So I think for my clients, and hopefully if you're watching this, you can kind of pick up on this. If you have a sizable amount of money, taking a portion of that and putting it into real estate, it tends to be kind of non-correlated, etc. And so that's very useful. So anyway, that's like a basic overview. I'll do some other videos on this in the future. But I wanted to kind of lay that out because, like I said, a lot of people I've talked to who don't really have experience with it are kind of like, oh, I don't know about that. It's like, look, it's a great asset if you buy well, right? And that takes some research. It takes some getting to know. It can be very safe. It can give you great cash flow, great return. It's not going to go 100x, right? But as a portion of your portfolio, as a place to put some money, it's great. Now, if you're interested in like something just like manage, reach out to me. I'll connect you with some people who, they're ones who I'll go to. And, they basically will take care of it for you, so you don't have to worry about that. So anyway, hope that's helpful. If you're interested in, like I said, any of these subjects, international investing, tax planning, reducing your taxes, asset protection, offshore company formation, offshore banking, residency, citizenships, etc., reach out to us. Clarity.fm/Michael Rosmer. There's a link below. Check out our websites, offshorecitizen.net, offshorecapitalist.com. If you haven't smashed the subscribe button, I hope you liked the video. If you did, click the like button. And if you have any questions, let us know in the comments. I will see you guys on the next video.